Half of Canada's biggest dealership groups aren't trying to defend against Chinese automakers. They're actively trying to partner with them. While headlines warn about low-cost Chinese EVs threatening Canadian jobs, a very different story is unfolding behind the scenes. Dealers who've spent decades selling American and Japanese brands, Ford, Toyota, and others, are now exploring franchise agreements with BYD. This is the same company that Ford's CEO, Jim Farley, once called an existential threat. Now it's on the verge of becoming a business partner. And once you understand why, it becomes clear that the real disruption in Canada's auto industry isn't coming from overseas. It's starting inside the dealerships themselves. Here's what dealers are looking at right now. In December 2025, vehicle sales dropped 7.3% compared to the previous year. January 2026 saw another decline of 2.9%. According to TD Economics, total vehicle sales in Canada are expected to fall by 4.3% this year. And that's considered an optimistic forecast, assuming trade tensions don't get worse. Even strong markets are weakening. British Columbia, long a leader in EV adoption, ended 2025 slightly down by 0.6%. Quebec performed even worse, with sales falling 3.2%. These are the two most important provinces for EV growth, and both are now in decline. What's really alarming dealers, though, is profitability. Since spring 2024, profit margins have been steadily shrinking. Even when sales volumes held up, earnings didn't. Dealers were selling cars but making less money on each one. The high profits seen during the pandemic years have disappeared, replaced by aggressive price cutting just to move inventory. One dealership owner summed it up clearly in Canadian Auto Dealer magazine. Sales might be stable, but profits have dropped across the board. Meanwhile, manufacturers continue pushing inventory to keep their factories running, leaving dealers stuck, paying higher interest on vehicles that aren't selling quickly. To cope, many dealers are slashing prices just to free up space. At the same time, financial pressure on consumers is rising. Loan delinquency rates have increased significantly, up 14.17% nationwide compared to 2024. Among younger buyers aged 26 to 35, delinquencies have jumped nearly 21%. For those aged 36 to 45, they've risen 16%. These aren't customers ready to spend $55,000 on a new EV. They're struggling to keep up with payments on the cars they already own. Even the Canadian Automobile Dealers Association acknowledges this shift. Their economist predicts that 2026 will bring a major change in consumer behavior. Household finances are under strain, and buyers have far less room for error than in recent years. Dealers see it clearly on showroom floors every day. Meanwhile, automakers are tightening dealer margins even further to fund their own transition to electric vehicles. Honda Canada has already reduced dealer margins to offset electrification costs. Ford continues to lose billions on its EV division, while still expecting dealers to invest heavily in charging infrastructure and service upgrades. The message is clear. Manufacturers are shifting the burden onto dealers while they focus on long-term transformation. And this is exactly where BYD enters the picture. As the world's largest EV manufacturer, selling 4.55 million vehicles in 2025, BYD doesn't face the same challenges. It has already completed its transition to electric vehicles and can produce EVs priced under 35,000 Canadian dollars. For dealers, the choice is straightforward. Try to sell expensive EVs to customers who can't afford them, or offer more affordable options that people are actually willing to buy. That's why right now, behind closed doors across Canada, dealership groups are in quiet negotiations. Firms like DSMA, which specialize in connecting Chinese automakers with international partners, are facilitating discussions. According to Jason Zhao, who leads Asian market development at DSMA, companies like BYD, Chery, and others are actively negotiating retail distribution agreements with Canadian dealers. It's a shift that could redefine the industry, and it's already underway. Dealership groups in Canada aren't just exploring partnerships with Chinese automakers, they're actively negotiating. The goal isn't years away either. The groundwork is already being laid to bring vehicles into the country before the end of 2026. What's striking is how widespread this shift is. About half of Canada's large dealership groups are aggressively pursuing these agreements right now. They're not waiting to see how things play out. They want to be first in line when Chinese EVs hit the market. The other half is taking a more cautious stance, watching closely before making a move. Among small and mid-sized dealer groups, interest is even stronger. For them, Chinese brands represent a way to enter the EV market without relying on high-priced models, often starting around $40,000, that many of their customers simply can't afford. BYD is expected to focus mainly on partnerships with large, well-established dealership groups that already have strong service networks and financial backing. Meanwhile, brands like Chery and Geely are casting a wider net, open to working with dealers of all sizes. This isn't just speculation. It's already happening. Recruiters from Chery have been reaching out to Canadian auto professionals on LinkedIn, hiring for roles tied to their Automotive and JQ sub-brands. They're building teams in advance, even before their vehicles officially arrive. There's a certain irony here. Dealers who spent decades selling cars designed to compete with Asian imports are now preparing to sell those imports themselves. In the end, survival matters more than brand loyalty. And it always has. So why is BYD standing out among all the Chinese automakers trying to enter Western markets? One major reason is its regulatory head start. Most people don't realize this, but BYD is already approved to sell vehicles in Canada. It's not waiting on certification or regulatory clearance. It's already listed in Transport Canada's Appendix G registry. This registry allows foreign manufacturers to import vehicles into the country, and BYD's passenger car factories in Shenzhen and Xi'an, where models like the Seal, Dolphin, Atto 3, and Seagull are built, have already been approved. And this didn't happen recently. While public discussions focused on tariffs and trade tensions, BYD was quietly handling the paperwork. It registered its manufacturing facilities, ensured compliance with Canadian safety standards, and secured authorization well in advance. In 2025, Transport Canada paused new Appendix G applications for passenger vehicles. That led many to assume Chinese automakers would face years of delays before entering the market. But BYD had already completed the process before the pause, giving it a major advantage over competitors. Other companies don't have that same head start. Geely, for example, could potentially route vehicles through brands it owns like Volvo and Polestar, which already have a presence in Canada. But fully independent Geely-branded EVs would still require separate approval. Meanwhile, companies like NIO, XPeng, and Li Auto would either have to wait for the Appendix G process to reopen or go through a much slower case-by-case approval system. That process involves reviewing and approving every individual vehicle identification number, which can take a long time. Industry experts say that manufacturers without pre-approved models could need a year or more just to meet Canadian safety and emission standards. Companies that already have approval, like BYD, can move much faster. In other words, BYD is ready now. When Canada's import quota system opened on March 1st, they were already in position. What many assumed was a closed door had actually been open to them for years. And there's another advantage that often gets overlooked: logistics. Unlike most automakers, BYD doesn't rely on third-party shipping companies. It operates its own fleet of car carrier ships. That means when it decides to send vehicles to Canada, It doesn't need to wait in line or negotiate shipping slots. It can move immediately using its own vessels. This matters because the first 24,500 import permits are being distributed on a first-come, first-served basis through August 31st. In a race like that, speed isn't just helpful. It's everything. In this kind of market, speed is everything. The companies that move fastest will capture the biggest share. And right now, BYD has two major advantages that are hard to beat: regulatory approval and control over its own logistics. Together, they give it a level of speed most competitors simply can't match. BYD also isn't new to Canada. Since 2019, it has operated a large electric bus assembly plant in Newmarket, Ontario, supplying vehicles to the Toronto Transit Commission. That means it already has a footprint in the country, along with established relationships, service infrastructure, and parts distribution systems. These are exactly the factors dealers care about when evaluating a new partnership. Can the company reliably deliver vehicles? Do they have the operational strength to support dealerships? Will parts and service be available when needed? On all of these fronts, BYD checks the boxes. While others were distracted by tariffs and policy debates, BYD was quietly building its foundation. And then the landscape shifted dramatically. In January 2026, Prime Minister Mark Carney signed a trade agreement that slashed tariffs on Chinese EVs from 100% down to just 6.1%. At the same time, a quota system was introduced, allowing 49,000 Chinese-made EVs into Canada this year, with that number expected to grow to 70,000 annually by 2030. Importantly, half of those vehicles must eventually be priced under 35,000 Canadian dollars. That's a huge deal, because affordable EVs are exactly what Canada has been missing. Right now, most new electric vehicles cost over $40,000, and even gasoline cars under $35,000 are becoming rare. Chinese automakers are stepping into a gap no one else has been able to fill. Take BYD's lineup as an example. Models like the Seagull and Dolphin are priced far lower in China, and even after factoring in shipping, certification, and dealer margins, they're expected to land in Canada at price points consumers have been asking for, and the demand is clearly there. Surveys show that a majority of Canadians are open to more Chinese EVs entering the market, and among those already considering an EV, interest is even higher. The only missing piece had been regulatory access, and that door officially opened on March 1st. Industry analysts expect demo vehicles to start arriving by mid-2026, with limited retail sales beginning later that year, likely in provinces like Quebec and British Columbia, where EV adoption is strongest. A full rollout is expected through 2027. That timing matters. Dealers signing agreements now will be the ones with inventory when demand peaks. Those who hesitate may find themselves watching from the sidelines. But there's a bigger question looming for dealers. It's not just whether to sell Chinese brands, it's whether their current brands can compete at all. When Jim Farley called Chinese EVs an existential threat, he wasn't exaggerating. The pricing gap alone tells the story. BYD significantly reduced the price of its Seal sedan over a few years, while rivals like Tesla saw little change in pricing for comparable models like the Model 3. Both companies manufacture in China. Both use similar battery technology, but one aggressively cut costs while the other largely held steady. The reason comes down to how BYD operates. Its level of vertical integration is on another level. The company doesn't just assemble cars. It controls nearly the entire supply chain. It sources its own lithium, manufactures its own batteries, including the cells, produces semiconductors, and builds vehicles end-to-end under one system. Analysts have pointed out that government subsidies also play a role, contributing to BYD's cost advantages. But subsidies alone don't explain the gap. The real edge comes from deep structural efficiencies that Western automakers can't replicate quickly. Meanwhile, traditional automakers are struggling with the financial burden of going electric. Ford, for example, has been losing billions on its EV division. In 2025, its Model E unit posted massive losses, following similar losses the year before. At the same time, its commercial vehicle division remained highly profitable. Highlighting the stark contrast within the same company, Ford has taken major steps to cut costs, including halting production of certain EV models and reducing its workforce in key areas. What was once seen as a necessary transition to secure the future has instead become a major financial strain. BYD, on the other hand, isn't dealing with that kind of pressure. Its EV business is already profitable and in some cases even outperforming competitors like Tesla in terms of margins. That difference changes everything. BYD's advantage keeps growing every year. While traditional automakers talk about reaching cost parity around 2027 or 2028, BYD is already there and has been for quite some time. So what happens when a BYD Dolphin shows up in Canada, priced around $32,000? How does that compare to something like the Chevrolet Equinox EV at $50,000 or the Ford Mustang Mach-E at $58,000? For most buyers looking at EVs, it's not about features. It's about what they can actually afford. Dealers understand this reality. They've watched EV pricing trends closely, and they see what's happening on their lots. Expensive EVs sitting unsold while customers wait for something within reach. Chinese brands aren't taking customers away. They're serving the customers legacy automakers have effectively priced out. But this shift isn't just economic. It's also political. Doug Ford has called Chinese EVs potential spy vehicles and pushed for a nationwide boycott. Meanwhile, Unifor, the country's largest private sector union, has warned that new trade deals could harm Canadian auto jobs. Even the Office of the United States Trade Representative has raised concerns. These aren't fringe opinions. They represent powerful political and labor groups that are likely to resist Chinese automakers entering the market. Dealers signing partnerships today are essentially betting that consumer demand will outweigh political resistance. Historically, that's often how things play out. When people are given affordable options, they tend to follow their wallets. That said, the transition won't be smooth. The first dealerships to sell BYD vehicles will likely face intense scrutiny, media attention, criticism, and possibly even protests. And as Chinese EVs actually begin to arrive, the political tension could increase rather than fade. Some dealers see this as an opportunity. Being first in the market could mean capturing demand before competitors react. Others see it as a risk that may not be worth taking. That's why the industry is split between those moving quickly and those holding back. What's clear, though, is that the ground is shifting fast. Major automakers are already scaling back in Canada. General Motors has reduced operations at its Oshawa plant. Stellantis has paused activity at its Brampton facility. Ford is retooling its Oakville plant with uncertain timelines. The manufacturing base that once seemed stable is now eroding in real time. Chinese automakers didn't create this trend, but they're accelerating it. Dealers watching all of this unfold are asking a practical question. If legacy automakers can't deliver affordable EVs and are pulling back from Canadian production, why should dealers rely on them for the future? According to TD Economics, vehicle sales in Canada are expected to drop from 1.89 million in 2025 to about 1.81 million in 2026, and that's the optimistic outlook. A worse scenario could involve rising trade tensions, complications with agreements like CUSMA, and even weaker consumer confidence. Against that backdrop, around 49,000 Chinese EVs are set to enter the Canadian market this year. That's less than 3% of total sales. But the impact isn't about volume. It's about positioning. If companies like BYD and Chery focus on the $25,000 to $35,000 range, they won't be competing with luxury EVs. They'll be competing with everyday vehicles like the Honda Civic and Toyota Corolla, cars that have long dominated the affordable segment. And that's exactly where traditional automakers are weakest in the EV space. Ford doesn't offer an EV under $40,000. GM eliminated its most affordable option when it discontinued the Bolt. Hyundai and Kia do have relatively affordable models, but supply limitations make them hard to find. Chinese manufacturers don't face those same constraints. BYD's production capacity is massive, far beyond what the Canadian market alone would demand. If they wanted to ship the full 49,000 vehicles in a single year, they could do it without much difficulty. That's why dealers getting involved now see the situation clearly. The real question isn't whether Chinese EVs will succeed in Canada, it's whether traditional automakers can respond quickly enough to compete. And many dealers are betting the answer is no. So when half of Canada's major dealership groups enter negotiations with Chinese automakers, it's not about ideology or loyalty, it's about economics. Profit margins are shrinking. Customers can't afford current EV prices. Domestic production is declining. And now there's a company with regulatory approval, its own logistics network, deep vertical integration, and products people actually want, ready to enter the market. Some industry experts warn that in a worst-case scenario, companies like GM and Ford could lose significant ground in Canada. That may sound extreme, but it becomes easier to imagine when you see North American production shrinking while Chinese manufacturers prepare to step in. This isn't a disruption dealers are passively watching, it's one they're choosing to be part of. The dealerships partnering with BYD aren't victims of change. They're positioning themselves at the front of it. A few years from now, Canada's auto industry could look completely different. The only real question is who prepared for it and who didn't.